All right, so here we are. We're going to start talking about the real estate tax chapter, chapter 8. So here's what we're going to be going over. We're going to be able to, at the end of this chapter, identify how they calculate real estate taxes and what type of real estate taxes there are. So let's talk about real estate taxes for a second. So taxes are a lien on the property. So the real property taxes, which the general real estate taxes are called your ad valorem taxes. Okay, your ad valorem taxes are going to take priority over any other lien on the home. So liens on the home are an encumbrance. Okay, they're a financial encumbrance, and real estate taxes are going to have priority over any other lien that you're going to have on said property. So your ad valorem tax is priority one as of January 1st of the calendar year. So every other lien that goes onto a property is actually going to be considered a they're going to go in priority of when they are recorded. So every other lien on the property, such as mechanics lien, mortgage lien, judgments, are going to go in order of recording date in regards to the priority in which they would be paid if there was either a sale, foreclosure, or anything of that nature. So again, going back to the two types of taxes that you have the ad valorem taxes, which this is your general real estate taxes. When someone asks you what are the annual taxes for the home, then they're probably referring to ad valorem taxes. Okay, ad valorem actually stands for is translated to according to value. So ad valorem is according to value. So the general real estate taxes are actually based on the assessed value of the home, the assessed value. Now, I want to just say this about assessed value. Assessed value is not the same as market value. Okay. So when we talk about appraisals and we talk about market value, okay, what you could get for your home on a fair market value, okay, that is going to be different from what you could get in regards to your assessed value. Your assessed value, if it is the same as market value, that is simply coincidental. Okay, that does not mean just because there is a similarity in market value and assessed value does not mean that there is a correlation between the two of them. It would just be coincidental if that was happening. Second type of real estate tax that we have is special assessment. Okay, special assessment, or they refer to it in this one as the specific assessment or an improvement tax. Basically, what that means is that let's say they put new sidewalk in front of your house. You were benefiting from that. They're going to levy a special assessment tax in addition to ad valorem taxes. Now, special assessment taxes are going to be specific to the properties that are benefiting, okay, and they will have to do with payment for the improvement as far as the benefit is concerned. You don't have a say in this. If they levy a special assessment tax on you, this is a power of state and local governments to do that. That's something that if you are benefiting from, a lot of times, like there's a sewer line coming into the street, and they're doing that so that you could hook up to a sewer line and public water. If you're in an area that traditionally has well and septic, that would be something that would be a special assessment. Sidewalk, as I said a couple seconds ago, also any street lights, things like that. So again, ad valorem taxes, according to the value, is what it stands for. And what I want to talk about is how we come up with our ad valorem taxes. Okay, so how we come up with our ad valorem taxes is this: is broken down by each property has an assessed value. Each property has an assessed value, and what they do is they take that assessed value and they multiply that by the town's tax rate, and you come up with an annual real estate tax that is your ad valorem taxes. So people always ask me, Stu, how do they come up with a tax rate? How do they come up with an assessed dollar value? I will go through that with you. Okay. So what happens is this: each town will take a budget, okay, gross budget. Okay. So you take the gross budget, Let's say that the gross budget is 300,000. Then what you do is you have to say, okay, we have to figure out how much one assessed dollar value of a home needs to contribute to that town budget. So what they'll do is they'll take the gross total assessed values in the town, okay, and they will divide the budget by the gross assessed value. That should give you a percentage. So if you had the example of 300,000 as your town budget, your total assessed values, let's say for this example, is 10 million, okay, you would get a tax rate of 3%. So then what you do is you would take the individual home, okay, or property that is being assessed. And what you do is you take then the assessed value of that, multiply it by the tax rate, and you will then get the annual gross real estate taxes. Now this goes into, again, special improvement, special assessment taxes. One thing I want to mention too is I told you that that real estate taxes are a lien on the property, and the liens are a financial encumbrance on the property. Let's talk a little bit too about what type of lien it is, because our liens could actually be different types of liens. So our tax liens are specific involuntary liens, means that we aren't taking out a mortgage, which is a voluntary action. We aren't we aren't doing work on the home, which is a voluntary action. Okay, both of those are voluntary actions. So taking out a mortgage, or having work done to the house where a mechanic would have a mechanic's lien on the home, would be voluntary. Okay, because no one's telling you have to do that by any power of the state or local government. And they're specific to the home because they're not going to go on to any other homes that you use. They will be specific to the property in which you are taking out the loan, or that you have the work done, right? So judgments are general liens because they're usually put on everything that the person owns, whether it be multiple real property, personal property, things like that. So our taxes are involuntary because the state and local governments levy those, okay? And they are specific, okay? And now it's talking mostly about the special assessment taxes in this slide. So we'll go back to the special assessments. I think I went over it. And here's the thing. There are some times where the improvements may be financed over many years if it's a major, major improvement. It's not super common. What you really need to take away from this is that special assessment taxes, or specific assessment taxes, are for improvements, and they are only to be paid by the people who are benefiting, okay, by the people who are benefiting from this. So the taxation process, we're going to go again into a little bit of this, where you have the assessed value, and you can actually, something I want to talk about too is this. You can appeal the assessed value, and you could appeal your taxes each year, because again, sometimes the assessed value is not founded in actual basis. There's sometimes where it's absolutely incorrect because the assessor is valuing it based on something that might be irrelevant or might not be something that is actually true. So you can appeal your real estate taxes. As a realtor, I do recommend that you look into the tax appeal process, because you do not need to be a CPA. You do not need to be an attorney to work with an appeal for taxes. And a lot of real estate professionals, what they do is they do offer that as a service to your client base. So it's something that come October, that's usually when tax appeals happen. A lot of real estate professionals offer that as a value, okay? And we've talked about tax rates already. We've talked about tax liens. The others right here, if you read the definitions of them, I think that would be sufficient for your knowledge base in regards to taxation, okay? Now we'll also talk about tax sales, because what happens is this. If you do not pay your taxes for more than 6 months, they will hold a tax lien sale. So what happens is they sell your tax lien. Now, if you hold a tax lien on the property, that does not mean that you have ownership. It means that you hold a lien that is going to be repaid within 2 years, okay, with reasonable costs and interest. So what happens is this. The sheriff actually sells the tax lien on the home, okay, if they're unpaid. And what happens is it basically goes towards, making sure that the whole of the budget is paid for and covered. And a lot of people who have money in the bank, what they do is they do like to hold tax liens because they usually are repaid with interest and legal costs. And they're usually paid within 2 years, so it's not like a long hold where you would have to sit there and wait like many, 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 many moons. And if the taxes do go unpaid, okay, excuse me, if there is not redeemed within 2 years, you can force a foreclosure, a tax foreclosure on the home. And then you would have to pay off the other liens on the home because there would be other liens associated with it, such as probably mechanics liens, mortgage liens, things of that nature. And then you could own or occupy the home or sell it if you wanted to. So some people do go into that realm of things. But again, it does get a little complicated. I suggest that if you do have interest in tax liens, learning more about tax sales, things like that, reach out to a real estate professional, reach out to myself, and be more than happy to explain to you how that works and what happens. So yeah, so that's the taxation process. Now, income tax issues. So here's what I'm going to do. Yeah, it says refer all queries to accountants or attorneys. I think that's very prudent advice in this one. But let's talk about capital gains exclusions. Who's excluded for capital gains? If you own and occupy the home for 2 years out of the last five before selling it, you can have up to $250,000 excluded from capital gains, or up to $500,000 for married filing jointly. Okay, so that's two numbers that I do want you to remember, because they will ask you about the exclusions from capital gains. What are capital gains? After expenses, what are you walking away with? You bought the home for 100,000, you're selling it for 200,000. Okay, if you had no other expenses, and let's say that, using round numbers in this example, you make $100,000. So if you do and you qualify, you own and occupy it for 2 years out of the last five prior to selling, you can exclude in capital gains taxes up to $250,000 for a single file, or $500,000 for married filing jointly. And that is real estate taxes, everybody.